Please, can we sit down, please? I think we've had two very interesting interviews with the head of the IMF and the World Bank. And I think that leads us to our panel. Fits right in because Bretton Woods has been working on the sovereign debt crisis for the last 2 years, actually the last 3 years. And we've come out with two very interesting reports, one on transparency, the latest one we did, which I think is a model for the need for transparency in the in the restructuring of the developing world that's gotten into such a terrible debt crisis because of many reasons, but mainly the COVID situation that hit us. And so the name of this new paper is Private Sector Engagement and Equitable Burden Sharing, a New Model. We decided to put the two of them together because really when you talk about the role of the private sector, you have to talk about burden sharing with both the official creditors as well as the countries that are most impacted. And we have a great panel, fortunately, here, and they have been given a draft of the report that we're working on, and we hope shortly to get out that report, and it'll have the same impact, and we hope even more so than the report on transparency. So we have Dr. Xuan, who's Deputy Governor of the People's Bank of China, having spent nearly 35, 40 years traveling to China regularly. I can say that the People's Bank of China is one of the greatest, I think, central banks in the world, and it's produced great leadership over time. And I think that the present staff of the bank is first rate. And many of the so-called deputy governors and others of the People's Bank of China have gone on to run very important positions in the Chinese government. I think it's sort of a university for economics in all of China. So I think it's a special pleasure to have the deputy governor. Yi Gang and Zhou Xuan were both close friends of mine, and I think did a tremendous, Yi Gang's still there doing a tremendous job, and Zhou Xuan was one of the great governors of the People's Bank of China. We're already very fortunate to have the two people who've written this report pretty much at the outset. Mark Walker, who's Senior Managing Director of Guggenheim Securities, but ran one of the largest legal firms in the United States, Cleary Gottlieb, and Rich Cooper, who is a partner of Cleary Gottlieb. And I would like to thank them tremendously because they put in endless hours, working on this paper, as they have on the previous two papers. We also have Carl Ross, who's a portfolio manager and sovereign credit analyst at GMO, who has wide experience in this area, and Trang Nguyen is a global head of emerging market credit strategy at BNP Paribas, which is, one of the largest international banks of the world. So having said that, we have a short time, and I took some of that away with my last interview, to really go over this subject, which is so important. And then my good friend and former Deputy Managing Director of the IMF, and I should say people tend to forget, for a number of months, actually acting Managing Director of the IMF, John Lipsky, will wrap it all up and take questions. So I would start with Dr. Xuan. Okay. Well, we've had a little bit of a change here because before we call on Dr. Xuan, I think we're going to ask Richard and Mark to come up first. And I think, Mark, you're going to do first, and then we'll have Richard. But again, I'd like to thank you very much for all you've done in not only this report, but the previous two reports. I think that you'll start thinking that I'm promoting Cleary Gottlieb here, since you're both, one former head and now a partner.
I'll just say a few words about the report itself. because I think the more interesting discussion will be when we get into some of the particular topics and the way we've suggest that people try to address them. The purpose of these reports that the Bretton Woods Sovereign Debt Working Group is preparing is to try to give helpful, practical, and actionable advice as to how the system can be, of dealing with sovereign debt can be improved. And we heard in the conversations earlier today some of the issues that have arisen. This report focuses on one main topic with two subtopics. And the main topic is how to improve and indeed expand the engagement of the private sector in lending to sovereign borrowers. It's important because the reality is that, on the one hand, the official sector, for all its resources, does not have sufficient resources by itself to provide the financing that is needed. And so we need to expand private sector. We need to keep the private sector funding that's there, but we also need to find ways to encourage that financing as well. Burden sharing comes in because the things that affect, or among the things that affect the decision of the private sector to invest are its expectations as to how it will be treated if, as is all too frequently in the case, things don't work out exactly as planned. So if at the end of the day the debtor is unable to honor all of its contractual obligations, how are those obligations modified, and how are different creditors affected? What the paper does in very brief terms is it examines a number of elements that are perhaps impediments to increased or even maintained private sector engagement. And over the last few years, private funding has gone down to the emerging markets, to lower and middle income countries, and it looks at a number of tools that Richard can talk about as to how to improve that. And then it looks at the question of how losses or compromises of claims are allocated among creditors if things don't work out as well. And that's a complicated situation. It's much more complicated than I think people imagine at first blush, because what goes into the question of comparability of treatment is not simply is my loan treated the same as Richard's loan or Carl's loan or Trang's loan, but how do you decide, first of all, what debt is compromised and what debt is left alone? If the multilaterals have lent 50% of the borrowings of the country and their debt is not restructured, then the burden that's going to have to be borne by the other creditors doubles in effect in order to provide the same level of debt sustainability. So the question of what's in and what's out is important. And then, as David Malpass mentioned, there's a great increase in the heterogeneity of credits and creditors. And so how do you compare the credit lent to a ongoing business that may be owned by the government, that may be generating revenue, and an unsecured loan to the government for general purposes? How do you compare a decision to lend new money to the government with somebody who says, I'm not going to lend new money, but I'll take a reduction in my current claims? So they're complicated questions, and the paper tries to outline a framework as how they're addressed. Richard?
Thanks, Mark. Yeah, I'll keep this brief because we've got a great panel. And I think Mark covered in high level, the topics in the paper. I would just add that, I think the basic premise of the paper, which I think is obvious, is that the flow of funds to the neediest developing countries needs to increase. And in order to do that, there are just a few options. You can imagine, increases from the official sector, and of course, I think that's something that we believe should take place and likely will take place. Increases from China, which has, as the previous speakers mentioned, is the largest lender to the developing world. But left to its own, unless there's a shift in the paradigm, so to speak. It's hard to imagine, given the other investment opportunities that are out there, particularly in this current investment climate, that there's going to be the kind of increase in scale and the reduction in cost, from the private sector. And so I think the paper analyzes, what are the tools that can be used to do that. We go through market-based tools, contractual tools, potentially legislative tools that can be used to encourage more flows from the private sector and for more accommodative debt relief in the context of restructuring when that's required.
Right. Okay. Thank you to the chair, Mr. Rhodes, and the speakers, Mr. Walker and Mr. Cooper, for the brief introduction of the report or paper, which has provided many good recommendations for private creditor engagement. I would like to share some of my observations. First, as the prior speaker mentioned, contractual mechanisms can be very useful to encourage greater participation by private creditors in debt restructurings. The report also, as mentioned in the report, enhancing the collective action clauses, or CACs, used in sovereign bonds has proved to be an effective tool for debt restructuring. In particular, inclusion of enhanced clauses in international sovereign bonds should be promoted, which are designed to facilitate a more efficient and orderly restructuring processes. Since 2014, substantial progress has been made in incorporating the enhanced clauses, but still a large number of outstanding bonds are without these clauses. Indeed, we could encourage broader use of enhanced CACs for more efficient restructuring processes. Second, there is a great potential for other innovative and flexible ways that private creditors can explore in debt treatment. For example, debt for equity swaps, where appropriate, allows developing countries to reduce their debt at state enterprise levels by exchanging debt for equity. And I think a particularly important side benefit of this swap approach, which would help improve corporate governance, and which would enable better management practices, and which could lead to better project returns that's benefiting both the private creditors and the debtor countries. Third, as many governments have outlined their ambitious climate transition plans, a deepened exploration of ESG bonds is also promising. This is an area that should receive more attention and become part of the agenda for many countries. And finally, I note that the report mentions China in several sections, as Mr. Cooper also mentions. And I would like to point out some of the views that are misinformed. And with time limit, I won't go to the details, but let me just touch upon two examples. The first one is that on China's share in the external debt of the poorest countries, which appears in the first page of the report. Paragraph 3 rightly recognizes the importance of the private creditors, who account for 21% of the IDA countries' sovereign debt, according to a World Bank report. But the references to China's share of 49% is actually not true, is actually misleading. In fact, by the same measure, China's share in IDA countries' sovereign debt is only 16%, as stated in the same World Bank report. The 49% mentioned here should refer to China's holding as a share in the group of all bilateral official creditors. The second one is on the role of China Development Bank, or CDB. The report notes that the CDB is considered a commercial creditor to allow it to receive better terms from debtors. I do not think this perception is true. For example, CDB is the only commercial creditor that participated in the G20 DSSI, or Debt Service
Suspension.
Suspension initiative, yes, you're right. Thank you. In that process, it offered quick reprofiling for debtors, and it received no better treatment than other creditors. On the contrary, in some cases, CDB has provided longer extension than other official creditors. I stop here. Thank you.
Thank you very much. 谢谢. So, Carl?
Thank you. Thanks for inviting me. Yeah, I guess a couple of things from my vantage point as somebody who helps manage emerging debt funds, and as somebody who is currently involved, unfortunately, in several debt restructurings. We're on the steering committee for Sri Lanka and Suriname, and to mention two. You know, the system now is one that, you know, is not working very well, and that's obviously referred to in the paper. It's the whole reason the paper's written. And in a nutshell, the way it's been working lately is a country gets into trouble. They either do a consent solicitation to ask bondholders to capitalize a coupon or two, and we always say yes, because the alternative is they're not going to pay us anyway. But it's a show of good faith that we always say yes, and sort of, you know, allow the country to kind of, you know, maybe 6 months to a year without being in formal default. And at that time, usually the country goes to the IMF and they try to get a program. And then it's basically a waiting game where everybody lawyers up and hires advisors.
Try not to take that personally.
and hires advisors, and then we wait for the IMF staff to basically come out with the DSA. And that can take, you know, a couple months, or it can take, you know, I don't know, a year. And, you know, we don't really have any, you know, input into that process. And one of the things that the bondholder community has been trying to do is to try to advocate for maybe us having some input into that process, because what happens is, you know, the country does a deal with the staff, and you know, you may get a glimpse into the assumptions. The assumptions are always very conservative, and I understand that, but they're more conservative than the ones we would assume, and they're also generally more conservative than the ones the country would assume. So if you look at Sri Lanka's, you know, DSA, I mean, you know, it's I think you have to say that it's operating under very conservative assumptions, which means a bigger haircut for bondholders. And so bondholders are sort of treated as this, I'd say, junior creditor, where, you know, the IMF and the country's advisors come up with this debt service envelope, and then bondholders are basically, okay, you're the residual. This is what, you know, we can afford to pay. This is the, you know, after we pay everybody else, this is the residual that's left over to pay bondholders, and that kind of dictates the haircut. And so, you know, it's been a little bit of a frustrating experience, and I think the pushback is that, you know, why do these assumptions have to be so conservative? Can't we structure something, you know, that maybe gives us some upside? And Kristalina actually mentioned that earlier, and so that's something that we're working on. You know, and why can't we have some input, you know, into that? And, you know, there's lots of legal problems with MNPI and so on and so forth, but I think, you know, we can get around that. But I guess one suggestion I would have would be, you know, more transparency into that process, and somehow allowing us to have a little bit more, you know, input into that process. I spend a lot of time out there. You know, a lot of talk today in the previous panels and interviews about the amount of money that needs to come from the private sector for development finance. And if you look at COVID, in 2020 and 2021, the number of countries that were able to issue bonds because they had a good payment record, they were able to issue bonds to help basically fund themselves through COVID, in addition to DSSI, debt relief, in addition to new money from the multilaterals and the official sector. bondholders actually put in a lot of new money too. And I think we don't get enough credit for that, but I will tell you that the countries appreciate that. And I think the countries value that market access. And so when I'm out there talking to asset allocators, end investors, pension funds that are trying to decide, do I put money into emerging debt fund, or do I put my money into a high-grade U.S. corporate bond fund where I know the rules, I know what I'm talking about, or a U.S. high-yield fund where at least I know the companies, or do I put money into an emerging debt fund? And the pitch is, when I'm trying to convince them to put money into an emerging debt fund and thus increase the pool of capital available to emerging countries, the pitch is that is sort of goes along the line of, well, countries generally try to avoid default. They don't want to default. They see the benefit of access to capital markets. And that's basically kind of the only leverage we have against them. And they ask me, they say, well, what do you do if they default? What rights do you have? How can you collect your money? And I say, well, actually, we can't really do much. Venezuela hasn't paid us for 6 years. Now, part of that is because our own government won't let us negotiate, they're sort of in the way there with sanctions. But we haven't sued them. We haven't tried to seize tankers, out on the open water. There's very little we can do, except rely on the fact that, a default is really costly and damages countries' reputation for a very long time. And so I'll finish with this, which is, if you lose that, what at least I can tell those asset allocators is, what I'd like to be able to tell them is, look, when a country defaults, we kind of have a good process where we can recover, some value. We can get 50 cents on the dollar, 60, 70 cents on the dollar for our claim. We're gonna lose money some of the time, but we're gonna make money most of the time. And when we lose money, there's a recovery process, and we're treated as a valued creditor. And there's kind of a level playing field. If you think that, if these asset allocators think that the deck is stacked against us, then they'll just put their money somewhere else, right? So I think as far as I think I'm trying to comment on the paper. I'm trying to give you some perspectives from an asset manager that. Some things along the lines of treating bondholders and private creditors, including us in the process, and more transparency and more communication, which I think is always beneficial, would be what I would say. And I was encouraged by the comments of Kristalina and David before we came up here, that they certainly seem to agree with that.
Yeah, and just to respond to that, I think the previous paper that we wrote on transparency and engagement was very much focused on those topics and the like, and looking not just to improve the process, but trying to, come up with incentives for sovereign debtors to kind of up the game, so to speak, with respect to those issues and the like. So.
Okay, we have as our last speaker someone who represents one of the great private financial institutions in the world, BNP Paribas, whose senior international advisor is my close friend, the former head of the International Monetary Fund, Jacques de la Rosière, who I must say is probably the premier financial statesman of Europe. So anything you have to say, I think, will be listened to very carefully.
Well, thank you so much, and thank you for having me. It's really a privilege to share the stage with such an esteemed panel. And thank you to Mark and Rich for sharing the draft of your paper with me. I've always enjoyed reading them. I think what Mark and Rich do really well is to distill very complex issues around the financial architecture. And also putting forward some really concrete and practical solutions and proposals as well. So I've spent all my career at large banks, so previously JP Morgan and now BNP Paribas. And while I certainly enjoy forums such like this one, I have to say that I probably spend about 80% of my time speaking to investors, so people like Carl. And so that also means that I have spent a disproportionate amount of time hearing investors moan about being vilified, if you will. So for sure, there is some degree of burden sharing and participation from all classes of creditors when it comes to fixing or enhancing the international financial architecture. But this is not to say that private creditors have been faultless either. I mean, we have examples of vulture funds, and Mark and Rich did mention this in their paper as well, but not all bondholders are bad. And since the conception of the common framework, there has been this ire from private creditors that they did not have a seat at the table, and that the architecture put forward by the common framework was designed based on archaic characteristics and constraints. Private creditors are now a much more important set of creditors, and if multilaterals want to eventually get paid back, it is in their best interest to ensure that the country does regain market access. So the buzzwords, reform of the IFIs, burden sharing, I think this really is music to investors' ears. Again, I applaud Mark and Rich for putting out this paper. I'm sure it'll be very well received once it's been published. I also look forward to hosting a roundtable on Thursday with investors as well. So some comments from the perspective of a sell-side analyst. So I've spent a lot of my time analyzing distressed countries in the past few years. There have been 11 countries that have defaulted since the onset of COVID. And are there more to come? Most likely. So I'll lay this out from a glass half full and maybe a glass half empty standpoint as well. So if you want to look at it from a more negative standpoint, well, next year, 2024, we'll see the highest amount of debt coming due by nations rated below investment grade. And this number is around 144 billion, which comprises multilaterals, bilateral, commercial debt, as well as Eurobonds. And when we're looking at the set of countries that have debt coming due, a lot of them have lost market access and still struggle to regain market access. So this means that the burden of rolling over their debt next year will rely on multilaterals and bilaterals, right? So this is what I would consider as a collision course with the fact that we have recession risks which are still looming, and this usually comes with higher credit premium, which means that the bar for countries to regain market access still remains very, very high. So this is to say that we've seen a wave of defaults already, but more are likely. Now, from the positive standpoint, the markets have priced this to a great degree already. So if you look at the set of countries which are rated CCC or below, that now represents 10% of all bonds outstanding. This has risen from 2% in 2019. So the countries that have undergone a great deal of distress and are likely to default are probably reflected by rating agencies as well as market pricing already. All right, so from a standpoint of asset managers, the mark-to-market losses have largely been borne already. So that's on the positive side, if you will. But my concern is that these debt workout processes are taking very long. Right? So the residual of the debt distress could still be felt for a long time because we currently don't have the architecture or the process in place to resolve these issues. And in a world where risk-free rates, so US Treasuries are giving you 4% in yield, it's very difficult to argue for allocating additional capital into emerging market debt, even if you think that eventually the recovery will be much higher than where prices are now. All right, so I do think that there is recognition that private creditors need to have a seat at the table and much early on. I do wonder, though, how that works practically when the design of the common framework doesn't officially include private creditors. But I do applaud the efforts to include private creditors earlier on in the process. And I think that that will eventually result in speedier debt restructuring processes. Right now, there's a humanitarian element to this as well. I mean, we all see the tragic situations in Pakistan, in Sri Lanka. It really took people to go to the streets to protest for the country to finally default on their debt. All right, so I think more than ever, there is an ESG angle to this. And that takes me to my next point. So in some of the solutions put forward by Mark and Rich, ESG or KPI bonds, so key performance indicators, were put forth as some proposals. So let me react to that from a sell-side analyst way of thinking. So on ESG, there has been a proliferation of ESG funding. However, there's an inherent income bias in this. The existing ESG frameworks tend to bias countries which are high income. So that means that new capital going into ESG type funds are going to countries that don't really need them, right? So how do we channel ESG type funding into the countries that actually need them? And I think there are several things to reassess in the framework and the architecture as well, given that a lot of the ESG type investments rely on third-party scoring systems. I think one single number to score country X doesn't tell the full story. And perhaps there is an argument to be made that it's the direction that matters more than the current score. So I think that we need to think about ESG funding, perhaps in a hybrid form of some of the solutions that you proposed, taking advantage of stabilization funds as well as credit enhancements, integrating that with some kind of ESG angle as well. So I think there are ways for us to stop perpetuating that ESG issue where countries which need ESG enhancements are not getting the money. The other issue around some of the solutions that you put forward that I potentially see is kind of the difficulty in getting the pricing and the analytics, right? So anything that's non-vanilla is usually met with some reluctance. And Carl, you know this very well, EM investors inherently are very benchmark driven. So if that bond is not in your index, people tend not to want to hold it. Now, there are index rules around what gets included and what doesn't get included. For a lot of indices, only vanilla instruments are included, so anything that doesn't have a known cash flow schedule is not included. So that means state contingent instruments have a hard time being included. So recently, JP Morgan indices have included credit enhancements as well. So that means the Ghana bond that's partially backed by the World Bank was indeed included. So that is a step in the right direction in my view. But there hasn't been enough changes in kind of benchmark reform, if you will, to enable investors to see some of these more innovative instruments as more mainstream. So I think the thinking is in the right direction, implementation, and also the process of embracing these more innovative instruments will be a multi-year process in my view.
All right, thank you very much. Now, my colleague, John Lipsky, will finalize his session and take questions. John?
Thanks, Bill. As Bill said, I'm not an interloper exactly. Bill and I are the co-chair of the Sovereign Debt Working Group of the Bretton Woods Committee. The panel's had an advantage that you don't have yet, but we hope to solve soon, and that is they've actually seen at least a draft edition of the report that we're about to put on private sector engagement and fair burden sharing. But I think what you heard clearly from the panel is very useful remarks, and I want to thank the panel for looking at the report and draft and making these comments. First, the big picture is we all recognize more funding is needed to deal with the problems facing emerging and developing economies. And it's also absolutely clear that if there's going to be a substantial step up in fund flows, it's going to have to include primarily increased flows from the private sector. So the question is, how can that be done? And the thesis of the report is first and foremost that there are numerous formats that could be more attractive to private investors. Clearly, if you can say, if the solution was simple, it would have been solved already. So we know it is going to be it's going to be complicated, as we've heard from the remarks from the panel. But the question is it impossibly complicated? And our conviction is no, that the solution or solving this problem and overcoming barriers to voluntary funds flows is very much worth the effort and is in the realm of possibility. Secondly is the issue of fair burden sharing. And I think we've heard some remarks in that regard that were consistent with, as you heard, with our earlier report on debt transparency. We hope that many of you or all of you have looked at it, and if you haven't, will take a look at. But one clear plea is for earlier inclusion of private sector in the process of formulating debt restructuring plans. That seems to be both possible, but also seemingly a sine qua non for increased participation. Now, we've also heard another thesis of the report, and that is, since we know that problems of need for debt restructuring inevitably occur from time to time, and what we've also heard is that, in fact, thanks to COVID and the ensuing issues, that the likelihood of a substantial number of countries in distress is going to be before us in the coming years. And the current situation is simply unacceptable and ineffective. There is no clear process that private sector investors can feel confident that they understand what is going to happen. Now, what we have heard, and I think for many of us who have worked on this in years past, that the collective action clauses seem to be positive. We've heard positive remarks about the potential for new forms. But what's going to happen for this to be real is for agreement to be reached on in a process that is clear and reliable. The common framework of the G20 was an attempt to move forward, but I think there's a general consensus. We've heard the comments today from the panel that suggest not enough. More needs to be done, that it doesn't represent a solution, but instead more consultation rather than confrontation is going to be required. And hopefully a beginning has been the creation of the Sovereign Debt Roundtable, whose first formal meeting is tomorrow, that does bring all the participants around the table. Obviously, this is not going to be easy, it's not going to be quick, it's not going to be an instant solution, but at least it's a step in which all the relevant participants are going to be speaking to each other. So we hope you will see in the report that it is quite detailed, and the work of the Sovereign Debt Working Group of the Bretton Woods Committee, that has been our goal, is not simply expressing desires for good outcomes, but trying to look for some possible concrete steps that could contribute in a very positive way. You'll see in the report a whole list of possible innovations that we think need to be considered, and obviously, if we're going to reach our goals, changes have to be made, both on the format of debt being issued, and secondly, in the process for dealing for restructuring and renovation of debt in problems of debt distress. So with that, first, thanks to the panel, but are there questions from from you, from the audience, on this topic that you'd like to ask to the panel, since it's lucky to have such experts with us. In the back, and then we'll get there. And the microphone will come. Please identify yourself, ask your question.
Yeah, I'm George Hoge from Chesham Investments in Boston. Flows to emerging markets have been heavily dominated by debt flows rather than equity flows. And typically, those mostly go to middle-income countries. My question has to do with the prospects for debt-to-equity swaps, which was mentioned by one of the panelists, where we see the most heavily affected countries, the IDA countries, where their debt burdens are unsustainable. What do you think are the prospects for debt-to-equity swaps? What are some of the issues that arise among investors in terms of their impact on the benchmarks? And how might we consider structuring bonds, which, like convertible bonds in the US, are convertible into public equity, might in fact go, for example, into facilities for climate change, facilities, which by nature are very long-term investments.
Thank you. Who in the panel would like to respond?
I can maybe take a stab at that. I think that for better or for worse, the financial world is split up into debt investors and equity investors. And from my standpoint, from where I sit, I think debt investors would have very little interest in a debt equity swap. A colleague from China did mention it. And I think there are certain types of private creditors, perhaps like the China Development Bank, that would welcome that. But from the point of view of bond investors, fixed income investors, I don't think there'd be a lot of interest. That's not to say that it wouldn't be appropriate for other types of private creditors, or it could be incorporated into a debt restructuring where other investors come in, and there may be some bond investors willing to let go of their claims for a certain number of cents on the dollar, and those claims could then get recycled by other investors into debt equity swaps. But it's a tough hill to climb. I don't think it should be ruled out, but it's a difficult one.
Anyone
Yeah,
else?
I would just like to add that it's something that, as a number of you know, we've had on the menu since Mexico back in the early 1980s, and it's worked sometimes and sometimes it hasn't. One of the real problems is corruption, is that we saw this in Argentina in particular. So it's an area that should be on the menu of options, but I think you have to tread very lightly on how you use it. I agree with Carl.
Yeah, I would just say that, I agree with both, but I think there's a way to get an equity-like return in a debt instrument, right? And so you see that in some of the, state contingent debt discussions. You see that, see them previously in oil warrants and the like, if you're investing in the sector and the like. Obviously, they have to be very carefully structured so as not to be a windfall and to tie it to specific sectors. But I think you can, certainly there have been, and you can imagine that type of equity-like return or upside, structured in a debt instrument. The issue, and I think Carl and others can talk about this, is valuing those instruments. And what are you giving up in return for agreeing to accept that? So,
Yes, sir.
There are success stories in China where debt for equity swaps actually worked out very well. And of course, the process can be complex, and the existing shareholders have to be on board. And so I think, but it does work, and we have success stories in China domestically. Thank you.
Yes.
Interesting point.
Microphone's on the way, not to worry.
Hello, Robert Charetta, President of International Investor. Since so much of this conference has focused on sustainability and green projects. I'd like to hear more about that bias question you brought up. Is there something more that the multilaterals could do to, if not steer, at least incentivize projects that are in those nations which most need private capital to do anything at all? And it would be a win-win for all concerned, including the world environment, if we could fund more of those projects.
I'll take that one. Well, I think it's already been done. The RST is exactly the step in the right direction for that. And Kristalina mentioned earlier that 5 countries have signed up and 44 more have expressed interest. So I think that's the mechanism for how the official sector can sponsor that initiative. But I think more importantly, in debt restructurings, we need to have more of an ESG angle. Right? Belize did exactly that, and I can see Sri Lanka being the prime candidate to also issue some kind of blue bond in a debt restructuring as well.
Anybody else?
I would just say that the report, we didn't talk about it today, but the report has a big section on how looking at what the official sector does, encouraging loans to the private sector in terms of credit support, whether it's indirect or direct. There's a lot of room for the official sector to provide credit enhancement in loans, both for ESG purposes and more generally, in new lending and in restructuring, to provide credit enhancement that would go a long way towards leveraging an increased participation of the private sector. And we do talk about examples where that's happening in ESG lending, and we agree in particular that because there's an added element of risk in an ESG loan to a country that is at higher risk of default, that it might make a lot of sense to have some sort of credit support as well.
Right, but as also made clear in the report, that's not simply the public sector should take the risks and the private sector should
No.
remain with the profits, but that there are ways in which this can be done
Yeah, I would just
sensibly.
add, John, that your point is very well taken, because when the World Bank started the A and B loans, the whole idea was to do this. It wasn't just that they were going to put out their money. It was to enhance loans that would be made by the private sector. So everything that's done in this area has to be value added. It can't just be doing one or the other, because otherwise there's no incentive for multilaterals to do this.
More questions? Yes, right here, gentleman right here.
Thanks a lot. I'm Adnan Hassan. I serve on the board of directors of the bank and group, and I'm an investor right now. When you guys were doing the debt restructuring back in Mexico and earlier era, the world was certainly a different place because we didn't have the large pools of sovereign funds and pension funds and private equity funds that now are active in the markets. So when you are looking at the debt restructuring discussions, the incentives that the sovereign funds have are not the same as the private equity funds and not the same as the pension funds. And when you do a debt to equity swap domestically, it's a very different thing than when you do it internationally, because you're obviously moving from debt to ownership. So how do you adjust the frameworks that you had in the big debt restructuring of the early era to a world that is a very, very different place today?
I think this is a tough question, because we were very lucky when people like Mark and myself worked on this, because the lending was basically all to banks. But when Nick Brady decided to put in the Brady plan, we securitized the debt and the whole world changed, as you mentioned. So it's much more difficult to do these things than it was in the 1980s and the early 90s. So it's a real challenge.
Indeed. Well, sadly, we are out of time. I think a big conclusion is, and I hope you will see it in the report, is where there's a will, there's a way. Let's hope we can summon the will, because the need is great, and there are ways, and the ways to find a solution is going to require cooperation and collaboration and not confrontation. But there has to be a desire to arrive at a solution, and if so, it can be done. Please join me in thanking the panelists. Thank you. And